What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Make sure you please subscribe. Please listen to this episode from start to finish. I promise you, you will not regret it. Please note anything discussed in this episode is not financial advice, so please do your own research before investing into any stock. In this particular episode, we're going to talk about PayPal stock, and we're going to ask ourselves, can PayPal turn around? PayPal is in the dumps. PayPal just hit another 52-week low even after its earnings report came out about 3 weeks ago at the time this episode will be releasing out. Will this stock come around? We're going to talk about its earnings release. We're going to talk about its particular prospects, and we're going to talk about some trades that I made related to PayPal and another stock as well. So please pay attention to this episode. Let's get right into it. Okay, everyone. So this is the Q1 23 PayPal earnings release. And there's only a few things I want to focus on in this. I want to focus on the Q1 revenue and EPS. I want to focus on the guidance, what the company is projecting moving forward, and I want us to look at the balance sheet. What is the balance sheet looking like for this particular company? Now, if we look at what the company is saying, the total payment volume, and the total payment volume is the volume of payments that is coming through their particular payment mediums, their payment exchanges, is 354.5 billion. That's up 10% year over year and 12% year over year on an FX neutral basis. So that's pretty much, that means foreign currency is pretty much neutral, okay? Because we know foreign currency will exchange. The net revenues is up 7 billion. That's growing 9% year over year and 10% excluding foreign exchange. The GAAP operating income was 1 billion. That's growing 41% year over year. And the non-GAAP operating income was 1.6 billion, growing 19% year over year. The GAAP EPS of 70 cents per share compared to 43 cents per share. That's growing 61% year over year. The non-GAAP EPS of $1.17 per share compared to 88 cents per share. That's growing 33%. And the operating cash flow, was 1.2 billion, and the free cash flow was 1 billion. So the company is doing pretty good from a revenue and EPS outperformance in the first quarter. And the company actually raised its guidance on the EPS side, okay? It's showing that the Q2 net revenues are going to grow 6.5% to 7% year over year, 7.5% to 8% excluding foreign exchange. The GAAP EPS is expected to be between 81 cents and 83 cents. And the non-GAAP EPS is expected to grow 24 to 26% to $1.15 to $1.17. Another thing I want to pay attention to is the forward GAAP EPS is now expected to be $3.42 compared to $2.09 in fiscal year 2022. The non-GAAP EPS is now expected to grow 20% to $4.95. And the share repurchases are expected to be 4 billion. Now, in my opinion, full disclosure, I believe that the company is putting too much money into share repurchases, and they may want to be focused more on growth. But I believe that these particular share repurchases may actually help me out in my particular trade that I'm going to show you all in a few minutes. Now, just showing the Q1 23 highlights. Now, Dan Schulman, president and CEO of PayPal, he said that PayPal has had a very good start to 2023 and delivered stronger than expected performance in the first quarter. We're working hard to continually improve our already popular checkout and digital wallet experiences, and it is beginning to pay off. We are confident in our momentum, and we are raising our full year EPS guidance as a result. So the company is having no issue after the first quarter saying that they are raising their prospects for profit for the full year. So that's something that I consider is good. But for some reason, Wall Street thinks that is bad. And we're going to get to the reasons why Wall Street thinks that is bad. But so far, the company is looking good from a revenue and an EPS standpoint at this particular time. And guidance is actually pretty good as well. Now on to the balance sheet. Now PayPal has, in my opinion, the best balance sheet in the fintech industry. We're going to go through these line items. The company is showing over 56 billion in total current assets and just under 44 billion in total current liabilities. So the company is very, very solvent. If we look at this from a particular standpoint, the company is showing 10.4 billion in long-term debt. Okay, but if we come down here to the cash equivalents and restricted cash at the end of the period, the company was showing 17.694 billion at the end of the period. So the company has well than enough more cash than what it needs to be able to cover its debt if it needs to pay it right now. So the company is doing very, very good from a cash management standpoint and from a cash flow standpoint. The company is doing very, very solid. The question is just all about the growth aspects, because there's all these questions about, can PayPal continue to grow? And that's the main thing that we need to focus on in the next segment. Now, I really want us to ask ourselves the question, why did PayPal stock fall 12% in one particular day? Now, I'm going to read the first half of this article because I believe this is the most important part of this article, just to give you some context around this particular issue. Now, PayPal stock can't catch a break. While the payments company delivered better than expected results for its first quarter on Monday, Wall Street was laser focused on PayPal's warning that its operating margins would expand by 100 basis points this year, down from the previous forecast of 125 basis points. Now, what we're talking about is pretty much PayPal said they would expand gross margins by about 1%. It's pretty much what they're saying, because 100 basis points is equivalent to 1%. So PayPal said that they're going to raise their margins about 1%, but they originally said that they will raise it by 1.25%. So we're talking about 1/4%, right? That's really what we're talking about in terms of the particular forecast. So, they say that that's the reason why the shares dived 12% in Tuesday's trading session, putting the stock on track for its steepest percentage point drop since February of 2022, when it fell 25%. And with the shares trading around $67 a piece, PayPal stock is on pace for its lowest close since 2017. Now, the weaker margin forecast comes as PayPal expects Braintree, its unbranded payment processing business, to drive more growth for the company. While growth is generally rewarded by Wall Street, Braintree is a lower margin business than PayPal's branded business, the latter of which is better known by customers as the PayPal checkout button. In the first quarter, Braintree saw a 30% increase in volume year over year, whereas Branded saw a 6.5% increase over the same period. Relative weakness in PayPal's branded business comes as payment companies face increasing competition. In March, Apple launched its Buy Now, Pay Later offering, entering a crowded space that includes PayPal, Affirm, Afterpay, Klarna. Google's probably going to come out with something. Apple's offering is tied to its wallet app, which could create a more seamless checkout process for shoppers than other payment options. Now, if I look at this particular situation and you tell me that the stock is down, 12% in a day, at this particular time, the stock was down 12% in one day because of 1/4% in a basis point bring in, I'm really truly gonna look at you like you're crazy. Because if we look at this particular situation, the payment processing business, right? I believe that the company should probably be more focused on this payment processing business, because that is what's delivering more growth. Okay, if we look at the payment checkouts and the buy now, pay later, that's a very, very crowded space. But if you're able to expand your payment processing business as a whole, that's going to help you out a lot, because you're already doing well from Venmo. You're already doing well from PayPal in terms of being able to exchange money from a digital wallet standpoint. But if you're able to grow this payment processing business, that's going to help you out from a bigger standpoint. I think a more bigger reason why the stock is down so much is because Wall Street may have lost faith in management. And there may be some uncertainty around who the new CEO will be. So Dan Schulman is the CEO of PayPal, and he is going to be stepping down and retiring at the end of this year. And the company is now trying to find a new CEO. And this new CEO is going to be very, very critical. And this is going to be has to be a very, very strategic hire. And they cannot miss on this, because you're competing against Square, you're competing against Shopify, you're competing against a company known as Stripe that is not public but may be coming public in the near future. You're competing very, very much against these particular companies. And so when you combine the operating margin guidance with the real uncertainty around who the CEO is going to be, and just the lack of growth that Wall Street may see in this particular stock, that's why you see the stock down so much and actually hit another 52-week low after this particular article came out. So that's a little bit more clarity in terms of why I personally believe that the stock is down so much. So I want to give you all some insight into some trades that I have got in very, very recently. And so let's start with the PayPal call that I got in the June 21st, 2024 expiration $70 call. Now, these are options contracts. And so options contracts expire. And so when you're trading a call, you're pretty much saying that I believe the stock is going to go higher. When you're trading a put, you believe a stock is going to go lower. So I bought 2 of these contracts, and these contracts costed $7.75 per contract. Now, that's the premium, right? That's the premium that I paid. You multiply that times 100, so that means that these contracts were around $775 per contract at the end of the day. Now, I bought these particular contracts on May 16th. So I've been in these contracts for about 2 weeks. And right now, the contracts are up about 7.33%. So it's up pretty good right now. Actually got a 13.65% day gain at the time of this video. So pretty good. And also have a Square call for the same expiration, but a $67.50 call. Now I bought that call at about $9.20, multiplied times 100. That costed me $920.66. I bought this call on May 17th, so that's about 2 weeks as well. And right now this call is up about 15.38%. So this particular call is up more than what the PayPal call is right now, but that's okay. Now let me give you some reasoning into why I bought these particular calls. Now, I personally wanted to buy these stocks on discounts, right? I wanted to buy these stocks because I've seen them beaten down so much, and they're at pre-COVID levels, right? They're at levels that we're seeing pre-COVID, but at the same time, the earnings are higher than what they were pre-COVID. And so I said, hey, I'm gonna buy a PayPal. I'm gonna get into a PayPal trade, and I'm going to get into a Square trade. And I bought more contracts of the PayPal than I did the Square, because I said, hey, PayPal is an S&P 500 company. PayPal's market cap is about double the market cap of Square's. PayPal, at the end of the day, if it's going to get some price appreciation, I believe that PayPal may get more institutional investment into it because of the fact that it is in the S&P 500. So I said, hey, PayPal may get slightly more of a price appreciation. On top of that, PayPal is actually investing more cash investing more cash back into its shares by repurchasing its shares. Can't hardly talk here. So the reason why that's important is because if PayPal is buying these shares at $61 a share, or $62 a share, or maybe even $60 a share, if they're buying those shares at those specific levels, that's a very, very good thing for me. And I may be able to benefit from that, and I may be able to see the price continue to appreciate. Now, Square, at the end of the day, Square and PayPal, they move the same, right? They're two fintech stocks in the same industry, and they move the same. They've been moving the same for the last 5 years, right? They move together, they trade together. They're like AMD and Nvidia, right? One may be higher than the other, but they're both going to move in the same direction. Same thing with Lowe's and Home Depot. One may be higher than the other, but they're both going to move in the same direction. And so I decided to buy two, and let's see what is going to actually happen with these particular ones. So you may be asking, okay, why would you buy, contracts so far out? The first reason why is because I believe that these strike prices are going to hit. Okay, I believe that they're going to hit, and I do believe that they're going to exceed, but I want to give myself time to do it. I've been in the market for a little while now, and what I see in the market is that I have a very, very good sense of how the market is going to move. I have a very, very good sense of what moves stocks. I have a very, very good sense of being able to establish what is a good stock and what is a bad stock, and being able to profit and being able to exploit opportunities in the market. The one thing that I'm not very good at is being able to tell you when they're going to happen. And so, hey, number one, I'm going to give myself a year. I'm going to give myself a year to be able to get the percentage return that I am looking for, be able to profit, take profits, reinvest into another position. The second thing is that I am trading options. And so options introduce leverage. Leverage introduces volatility. Volatility introduces those Greeks that are associated with the options contracts. The main one that I do not like is theta. Theta is the one that I hate, because theta is the one that allows my options contract to lose value, right? It's the one that allows my options contract to lose value. So what does that mean? Theta, so if a stock price is going down and you're getting closer and closer and closer to your expiration, is going to just suck away so much of your particular profit, and it's going to just eat away at your options contracts. Theta, when you're buying contracts that are far out into the future, a year in advance, theta is pretty much irrelevant. A stock could have a healthy pullback, but then it could come back up to that same value, and theta won't even be able to affect it, and it'll be at the exact same price, pretending as if the stock didn't even go down. And so, I'm giving you a glimpse into my portfolio. I'm letting you see what's going on. I'm going to update you on this, but specifically from a PayPal perspective, what's gonna get me to that $70 call and beyond? What's actually going to get me to that specific strike price? So one thing that I'm looking at with PayPal specifically is the analyst price target. Now, analyst price targets should not be taken as the Bible. You should not just take the price target and say, hey, this is what this stock is going to get to in this particular time. But analyst price targets are there for a reason, and you should use them as a tool, and you should use them as a guide to see what the analyst may think. So the average price target, even after the steep decline the stock has had, is still $96.83. That's a 56% upside where the stock is right now. The highest is $160, and the lowest is, what do you know, $70. The exact strike price that I'm looking for, right? That is the particular, that's what I'm particularly looking at, right? I'm saying that, hey, I'm not even saying that we're going to get the $96. It's not even what I'm saying. I'm saying that the stock is going to have some level of appreciation to at least get us 270 and past 70, so I can get to my profit goal, take my profit, reposition, and go into another position. Now, from a technical perspective, okay, if we look at this PayPal chart, okay, from a technical perspective, if we look at this PayPal chart, we look at it, right? This is a monthly chart now. You look at what the stock has done since 2017, like we talked about earlier. It went up, it went way up here, and then it just crashed on down. And so now we're in levels to where we were back in 2017, right? I think, me personally, that this stock is not going to go any lower. I believe that we were at former major resistance back in 2017, and now that former resistance is now going to turn to support now. And I believe that we really truly have some support. I'm making a bet that the stock is not going to go much lower than this. And I believe that we're going to have some type of price appreciation. If you look at the things, I'm just going to take the company as word and just say that, hey, the company is going to be able to deliver. I'm going to say, hey, the company is going to be able to find a CEO that can help execute, and that's going to help me be able to appreciate from an options perspective, get my profits, get out. I'm not saying that I want to be in this stock forever, hold it for long term. What I am saying is that I see this as an opportunity because the stock is so low and it's so undervalued. This is an opportunity for you to get into a particular position, being able to appreciate, get some price appreciations by using leverage and options, and being able to get out. That's pretty much what I'm seeing for my specific trades. So you all were able to get a look into one of my options portfolios that I utilize to trade options with. Since I showed you the positions and let you know when I got into them, that means I have to let you know when I get out of them. So I'm going to make sure I tell you about the position, let you know what I'm thinking, and just let you know everything that's going on with these particular positions that I showed you on tonight. Now, at the end of the day, this is what I want you to know, and this is what I want you to understand about this particular stock. The stock is beaten down, right? Wall Street is really in the dumps right now. You know, it's really in the doghouse right now in terms of Wall Street. But the stock has an opportunity to revive itself. Whether you're trading it from options, whether you're trading it from a share perspective, the stock has an opportunity to have some level of appreciation. Am I telling you stock is going to go up 100%? I'm not telling you stock is going up 100%. Am I telling you it's going up 200%? Definitely not. But can the stock get up 15%? Definitely it can. Can it get up 20%, 100%? If we look at the average price target of $94 a share, $96 a share, whatever it was, a 56% upside from where it is right now, that gives you some clarity into what people are thinking about this particular stock. But I'm telling you, look, as always, do your own research before investing into any stock, okay? Any trade that I give out on this platform or any other platform that I may create, you have to invest at your own risk. This is your own risk, okay? I'm not a financial advisor. I'm not a fiduciary. I'm just giving you what I am doing for educational purposes only. So I'm telling you, PayPal has an opportunity to come around. And at the end of the day, I believe the risk to reward ratio is in my favor at this particular time. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Reach out to me in the comments and let me know how you feel about PayPal stock. Let me know how you feel about PayPal's competitors like Block or just any other fintech company on the stock market. Do you think fintech is dead? Do you believe that we should be just throwing fintech in the trash? Let me know how you feel about what I am doing in my portfolio. As always, remember, don't pay for it, trade for it. I'm gonna tap in with y'all in the next episode.